Since going public in 1985, Costco's shares are up 110,000%. So how in the world does a retailer, a company that is really just a giant warehouse with pallets full of products, not a big selection, how do they beat their competitors in the retail market? That's what I'm going to dig into today, is just how this company does it. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So to understand Costco, you first have to look at what the membership business looks like and what the incentives are. I'm going to start with the membership revenue. This is just simply the revenue that Costco generates from members every year, and they slowly raise these over time. But revenue typically grows as the number of members grows. So you open a new store, you have capacity for more members, that's going to increase your membership revenue. But this is really where the profit comes from. Costco does not make much money on running each individual store. It makes money on the membership. Now, with that incentive in mind, that's when you can start looking at the core business. Now, the first thing I want to do is actually compare the membership revenue to the company's net income overall. And you can see that today net income is more than the membership revenue, but that was not the case until the last few years. And that means that each store was basically operating break even in those early years, mid 2010s, they were actually losing money in each one of those stores. So that means that the company must have really low margins on the products that they're selling, and that's absolutely the case. You can see here that their gross profit margin, just 12.6% in the most recent year, and their operating margin is just 3.6%. So let's look at that compared to some of their big competitors, because this is a really competitive space. But like I said earlier, Costco has different incentives from most of its competitors. So let's look at the same metrics for Target and Walmart. This is a look at Target's gross margin in red and operating margin in blue. You can see that both of those are higher than Costco. That means that in general, they're going to have higher prices than Costco on everything that they're selling. The same can be said for Walmart, which has lower prices, lower margins from a gross margin perspective. More volume goes through each of their stores. So they have a solid 4.3% operating margin, but again, much higher gross margins and operating margins than Costco has. And this is the theme in retail, is if you make all of your profit on these memberships, then you can run the box at a break-even basis. The incentives then becomes, how do you lower all your prices and offer the best price that you possibly can to your customers? This is exactly what Costco does. They don't have 15 brands of peanut butter. They have one brand of peanut butter, and it comes on a pallet, and that pallet just sits in the store. They do everything at scale so that they can lower their costs, and then as a result, lower their prices for their customers. Once you do that and they're paying the membership to get in the door, the customer has an incentive to keep coming back. And it's a flywheel that keeps going. That's why Costco has been so successful as a business. They have a completely different business model than their retail competitors. It allows them to keep having lower prices, and that keeps customers coming back time and time again. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. But what should we be paying for Costco today? That's really the big question. And this chart I think is really interesting, because if you go back to 2015, Costco's price to earnings multiple was about 26. That's a pretty reasonable average market multiple to be paying for a stock. Right now, that price to earnings multiple is 60 times right now. The price to sales multiple was 0.5 in 2015. Today, that's 1.7. So this is still a phenomenal business. Like I said, different economics than a lot of its competitors, but is there limits on the growth that Costco can have long term? And should we be paying that kind of multiple? Well, while this is still a growth company, it's not a very high growth company today. This is the revenue change in each year over the past decade. You can see that over the past year, revenue is up just 5%. So that's not a ton of revenue growth, especially when you look at what Costco's multiple is trading for. The other thing is Costco's ability to grow its revenue is a little bit limited. It's limited by the number of warehouses that there are and the number of members that you're going to be able to have in each warehouse. You can see here that membership has grown slightly faster than the number of warehouses, but not a lot faster, because Costco wants to have a good experience for each one of those members when they join a warehouse. So you're going to be capped on the number of members you're going to be able to have, and you're going to be capped on the number of warehouses you're going to be able to have just based on geography. They're expanding internationally, expanding into Canada, but this is not a company that's going to increase the number of warehouses at a 10 or 20% rate on an annualized basis. So this is an absolute monster stock, a phenomenal win for investors because they have a differentiated business model. But the question is, what should you pay for a company like that? And this is really something that's going on throughout the market today. Very, very high multiple, no matter how you look at it. So from that perspective, I don't think Costco is a great buy today, but it is a great company to learn from because it really pioneered and showed the value of the membership business model. And that's ultimately what I'm going to take from it. Now, there are a couple of interesting companies that are implementing similar benefits to a membership business model that I think was worth paying attention to. One of those is Robinhood with their gold membership. This is a membership that you're going to pay $5 a month for. And for that, you get a higher interest rate on the cash that's sitting in your Robinhood account. There's a 3% back credit card that you can get. There's matches for deposits into a IRA, into a Roth IRA, a number of different benefits that can more than pay for that membership. But again, what Robinhood is doing is they're saying we're happy to lose money on the back end in some of those products because we have this guaranteed money that's coming in from the membership. And by the way, the value that we're going to generate by having more assets under management is going to be beneficial for us long term, because that's going to be a long-term relationship that we're building with those customers. And that's something that we're going to be able to monetize over years and decades. So this is the way that companies have to think about memberships, is if you're going to be able to charge a membership, it's going to change your economics on the back end. Costco is really one of the leaders in doing that. I think Amazon is another phenomenal example. Amazon Prime is one of the most popular memberships in the world. As a result, they can actually lose money on shipping, but it keeps customers coming back again and again and again. And all the ancillary businesses that Amazon has built in the meantime, things like their advertising business, AWS, even Prime Video, is based on the fact that they have those customers who are coming back again and again to Amazon to shop because they are paying for their annual membership with Amazon Prime. So it just changes the economics of a business and the incentives of everyone involved if you have a membership business like Costco does. And that's why this has been such a phenomenal business for so long. The big question is there any run room left in the stock because of the price that investors are paying today? That's one of the reasons I'm not buying Costco stock today, because I think it's just too expensive, especially given the growth rate that we see in the core business. But it's a phenomenal business to learn from, because companies that are successful in building a membership model can have a huge moat, because companies with a traditional business model just can't operate with the same incentive structure. And that's really what I think investors should take away from Costco. But let me know what you think about Costco today and even the price. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.